Hi, I'm Brooke Thackeray. Welcome to Last Month, This Month for the months of September and October. Today I'd like to take a look at the performance of the broad stock market indices in the month of September and the sectors of the stock market as well. And let's look forward to October and see what the seasonal trends are for the both the stock market and also to the sectors of the market. Now this time around, and it's an election year, so it's particularly important with the overall election trends as well. So let's jump right in by taking a look at what happened in September. So if we take a look at the broad stock market indices for the performance in September, you can see that the S&P 500 was actually down approximately 4%, just under 4%. The NASDAQ Composite Index was a big loser, as it underperformed the S&P 500 and produced a loss of just over 5%. Now, the NASDAQ's been leading the S&P 500 over the last number of months through the pandemic. So this is a little bit of a shift that's taking place as well. And if we take a look at the S&P TSX Composite Index, you can see here that it had a loss of 2.4%, which is not nearly as much as what the S&P 500 was. If we take a look at selected subsectors of the S&P 500, you can see the big loser was the energy sector, which produced a loss of almost 15%, which is just huge overall. This red line represents the performance of the S&P 500. And also interestingly enough was the consumer services sector and the technology sector both underperforming the S&P 500. Now these sectors have been the leaders in the market for quite a few months overall. So we're starting to see a little bit of a weakness that's taking place in the leading sectors through the pandemic, with a lot of these sectors being the work from home as well. So and what's taking place is we're seeing a shift on some days to the industrial sector or the material sector, some of the cyclical sectors going back and forth. And you can see here the industrial sector in September was only down 0.7%, and the material sector was actually positive as well. And as far as the defensive sectors go, the staple sector, healthcare sector, both outperformed the S&P 500, and the utility sector was actually positive as well. So if we take a look at the selected subsectors, now this is just selected subsectors, we can see here that silver was a big loser in the month of September. Now, silver's been the talk for so long about how it was undervalued relative to gold, et cetera, but it did go down approximately 18% in the month of September. Now, gold was actually down just over 4%, so it underperformed the S&P 500. And metals and mining, interestingly enough, was down over 6%, which underperformed as well. So when you get gold and metals and mining underperforming the S&P 500 and being negative, you tend to see silver actually take it a little bit on the chin as well. So what's interesting in this case is that the metals and mining sector, which is also a cyclical sector, didn't do well, despite some of the sectors like industrials and materials doing okay, at least relative to the S&P 500. Home builders was a positive surprise in the month of September as well. Transportation is an interesting sector, slightly positive in the month of September. Now, that's not seasonally when it tends to do well, but we saw some strength in the transportation sector with some good numbers coming through that sector. Now, it's yet to be seen if companies are saying to themselves, look, we learned a lesson. You know, we really slowed things down before in manufacturing and whatnot, and we ran out of goods. You know, consumers were still buying goods. Now, a lot of companies have been really badly hurt through the pandemic. There's no question at all. And, you know, that's a bad thing. But some companies have actually done quite well. And there's been some shortages as far as products goes. And maybe some of what's happening is some of the companies are saying, look, there's a second wave potentially coming through. You know, let's order all our product so the consumers, you know, if they are going to go through this spending binge, we will actually have product on hand. So the transportation sector is actually been performing well. Let's see if it's got some carry forward as well. So what's coming up in the month of October? If we take a look at the some of the economic reports we did see on Friday, because we're just into the month of October here now, we did see a report of 661,000 on the non-farm payroll number, which is less than expected. Now, it really didn't have a huge impact on the day. The main news of the day was, you know, COVID-19 for Trump. He was diagnosed with COVID-19 on Thursday, affecting the markets a little bit on Friday. But also, too, as well, we did see the unemployment rate slip below 7.9%, well, to 7.9%, below 8%, which is a fairly good threshold as well. So it didn't, you know, the negative non-farm payroll number, less than expected, didn't have a huge impact on the market. This week coming up, we do see on Wednesday the 7th, we do see the FOMC minutes. We get a glimpse of what the Federal Reserve is thinking about, and not just telling us, but some of their discussions as well. On the 13th, we get some of the inflation numbers, and the inflation numbers, at least as how they're reported, are still expected to come in well below 2%, despite the Federal Reserve saying, hey, we're going to this average inflation target policy in the future, and we might let inflation run hot. We're still not there. It could be a problem in the future, but right now our inflation numbers, as they're officially reported, are still well below 2% in the States. We see retail sales come out on Friday the 16th as well. Interestingly enough, retail sales are actually doing well. Even if you take out Amazon, at least in the stock market, the retail sales company, take out Amazon, retail sales companies are actually doing quite well, despite that whole shutdown that's taken place in some of the bricks and mortars locations. Housing starts on the 20th. Housing starts have actually been quite strong. Durable goods, we'll get an idea as far as the overall economic growth as well. That a lot of people will look at this figure. And then we have GDP on the 29th as well. But the big news really this month is this is earnings month. There's been so much going on. We've sort of let it slip by a little bit, but earnings month for the Q3 earnings season. And we have the financials unofficially kicking off the earnings month as well. So if we take a look at, we got JP Morgan Chase, Citigroup, reporting on the 13th, really kicking off the earnings season. We got United Healthcare, Bank of America, Goldman Sachs, U.S. Bank Corp, Wells Fargo, then Morgan Stanley. So we got a lot of earnings coming up. So there's a couple things as far as earnings goes. Well, we want to see a reaction of investors to the earnings that are coming out. So sometimes it's not just the numbers that are reported, but what are the actions of the investors? Maybe if they're not so good and investors are still bullish, that's actually a bullish sign as well. So we do want to take a look at this. This earnings season is actually kind of interesting because analysts have actually raised their expectations for earnings, which is really unusual. The last time that happened was back in 2010, and it usually happens coming off of recessions. Now, we've seen some rapid growth taking place, but analysts have raised their expectations, and so we might see a little bit of a higher bar to beat here as we go forward through the earnings season. It's going to be definitely interesting. We do see Visa coming out on the 21st, Barrick Gold, Microsoft, Amazon, UPS. Now, interestingly, UPS has done extremely well because of the work from home and everybody shopping online. And they actually start their seasonal period from October 10th into early December. But they've done really well coming into their seasonal period ahead of time. It'll be interesting to see if this momentum can actually keep up. Then we got Google or Alphabet, Tesla coming up a little bit later on in the month. Obviously, a lot of people look at Tesla, at least for some entertainment value as well. Facebook coming up, Apple coming out. That's going to be a big one for a lot of people as well. Their earnings coming out on the 29th, Newmont Mining, and then we get a look at the energy sector with Exxon Mobil Corp. Now, the technicals for the S&P 500, last month I talked about this megaphone pattern, which is higher highs taking place and lower lows, which is typically a consolidation pattern for the S&P 500 or any stock market. It's a consolidation pattern that often leads to lower markets. That hasn't happened. We did see at the end of August and into early September, we did see that bounce right off the top of the line, and we have seen a pullback. We are starting to see a little bit of strength in the market right here, but it's going to be interesting to see if the S&P 500 is able to break through on the upside of this pattern in the near future. But just on a cautionary aside, technically this typically is a consolidation pattern. We really need to see some strong news coming out to help push that stock market higher through that pattern on the upside. Overall, if we go back on the long-term monthly trend for October, on the major sectors of the market, we take a look. Technology actually tends to be one of the better performing sectors we're looking at the entire month overall. Consumer staples. Now, this is an interesting figure. It's at the top of the stack, close to the top of the stack. For the major sectors of the market with an average return of 2.5%, and outperforms the S&P 500 59% of the time on average as well. So the consumer staple sector tends to do well in the transition months, and whereas we move into the more favorable seasonal period for the stock market, you tend to find the consumer staples actually performing well, which is in the month of October. Let's go down and take a look at the bottom. Energy, which had a terrible month in the month of September, is actually close to the bottom. Industrials, now I want to say this about industrials. Industrials has been showing a little bit of strength recently relative to the S&P 500. A lot of rotations being taking place into the industrial sector as well. And it's actually outperformed the S&P 500 only 38% of a month, or 38% of the time in the month of October. But it does start its seasonal period towards the end of October and tends to outperform in the month of November. So maybe we're seeing a little bit of that happening early. I have to watch that dynamic unfold here. If we take a look at some of the subsectors for the market, this is just a selected sample of subsectors. The agriculture sector tends to do well. We haven't seen the agriculture sector really shoot up here yet. It starts in late September. We haven't seen that uptick in performance. It could happen very shortly. Transportation, which has actually been performing well in September, tends to be one of the better sector performers as well. Railroads as well. Steel tends to do okay here. I want to point out the bottom of the barrel here. Silver and gold. Now these are the relative, the number of percentage, I should say the frequency of percentage that the sector outperforms the S&P 500. So on average, gold has lost in the month of October 1% and only outperformed the S&P 500 24% of the time. And silver has on average from 1990 to 2018 has lost an average of 1.4% and has only outperformed the S&P 500 31% of the time. I'm going to talk a little bit about gold coming up shortly as well. So we take a look. This is the overall general market trend on average for the month of October from 1950 to 2018. You can see here, on average, it's a positive month. It's got a bad reputation, but that's because it tends to be one of the more volatile months of the year, and which October can lead to some good buying opportunities in the volatility. We haven't seen any so far. We just started October, but we haven't seen any large volatility moves in October, but it could happen, especially given that we are in the election year. You can see here that on average, the soft, weaker part of the underbelly for the S&P 500 in the month of October is really about 3/4 of the way through. We tend to see a little bit of pullback, and that's also confirmed on the number of frequency of positive incidences per day on average from 1950 to 2018. So we could see a little bit of opportunity, and really it's around this point that the 6-month favorable seasonal period for the stock market starts on October 28th. I just want to point out something overall, what's taking place in the overall market right now. This is from my August newsletter in 2020. I put in a big, huge black square and said, this is the unofficial period for the Federal Reserve starting up. And here basically I said that once we slip into October, the odds of a large Federal Reserve actions decreases substantially. And it's difficult for the Federal Reserve to actually initiate a big, huge action in the election period. Sure, it could be done if necessary. And it's not saying the Federal Reserve won't do anything, but it's difficult for them to come up and say, hey, here's a brand new policy. We're ramping up our purchases substantially. And particularly because the economy is doing okay, it'd be difficult for the Federal Reserve to do this. So we are in that period where the Federal Reserve actually holds back a bit. And if we take a look and see what's happening on the Federal Reserve balance sheet, you can see here after this skyrocketing, dumping huge amounts of liquidity into the market, taking the Reserve balance sheet up to over $7 trillion. We did see this consolidation take place. Not consolidation, but just this pause in expansion of the balance sheet. And so this is in the time period when the stock market's been really trying to find some footing overall, because the Federal Reserve hasn't really been pumping higher on this to help support the stock market. Now, I want to talk about a couple sectors in the stock market that actually finished their seasonal period in October. Now, October, towards the end of October, we start to see a lot of sectors start their seasonal period. And I'll describe this in my newsletter that I put out as well. But, things like industrials, materials, transportation, a lot of the cyclical sectors start their seasonal period and typically towards the end of the month. But there's a couple sectors that really get talked a lot about in the media. I wanted to bring them in today to talk about, from a seasonal perspective, that now may not be the best time for those sectors. The first one is U.S. government bonds. On average, U.S. government bonds finish their seasonal period on October the 3rd. So early October, U.S. government bonds tend to turn down. And this happens, one of the reasons for that is that economic expectations on average tend to pick up at this time of the year. And also, too, you see a rotation out of, as the stock market tends to move up, investors start to rotate from bonds into stocks as well. So this is the time period where bonds can actually pull back overall. Now, there may be a long term case for actually holding government bonds, because interest rates are going to go lower. That's not what this is about. This is just saying on a seasonal basis, government bonds tend to be a little bit weaker at this time. If we take a look back over the last 10 years, and I've put these blue lines here to show you the beginning of October. And the red arrow basically represents when bonds have turned down at the beginning of October and have been lower from October into the end of the year. And so despite bonds actually performing well, and in this case I'm using the ETF IEF, which is U.S. government 7 to 10 year government bonds, despite bonds actually moving up overall on average throughout this period, you can see here that 7 out of the last 10 years, we've seen this downturn that takes place before bonds actually move up again, and sometimes bigger than others as well. Now, interestingly enough, let's go back to 2019. We saw this really strong upturn for bonds in 2019, and we did see this contraction that took place from October into the end of December for bonds, and once that took place, bonds went up. So this is the time period from now until the end of the year where government bonds can actually pull back. And a lot of people have a lot of money in bonds, so it's just something to think about from a seasonal period. Now, interestingly, we've seen this real consolidation take place. It's almost been flat. Sure, there's been a downtick and an uptick here as well, but overall, we've been fairly flat in bonds here, which is a little bit unusual overall, given the length of time and how flat we are. I'm going to zoom into this particular period here. If we take a look here, we can see that I put the coyote here because it's just for a little bit of fun, because this is like a plateau. And at some point, bonds, and now I will say that part of the reason why that we've got this plateau is because the Federal Reserve has been, saying, look, we're not thinking about raising rates, and they're in the market, and so they've been actually manipulating the market. There's no question about it. But we do have this plateau, and at some point it's going to break a little bit higher or lower. It can be very difficult for it to stay on this plateau on a seasonal basis. We tend to see bond interest rates tick up and bonds turn down from now until the end of December. So, bond bulls are hoping that the coyote doesn't actually go to the end of this. And the coyote here that I'm referencing is from the old cartoon comic show with the Roadrunner. And the coyote very often would go off a cliff and then, like this, run off a plateau and then fall down. And bond bulls are hoping the coyote doesn't move further and then obviously take a plunge down here. But just something to think about from a seasonal perspective. The bonds actually tends to be a little bit weaker this time period, and we're starting to see a little bit of uptick in interest rates right now. So it looks like we could see the same follow through overall in the seasonal trend as well. I also want to take a look at gold, because gold has been talked about for so long. It's been a darling for the media in 2020 and 2019 as well. And gold's performed extremely well. And sure, there's a long-term case that, the central banks are printing money and governments are spending money, and there's going to be hyperinflation or stagflation down the road. Absolutely, you can make a case for that. But we're just going to look at the seasonal period for gold right now. Now, I want to say before I start, first of all, gold is just finishing a seasonal period of strength, and it has another seasonal period of strength that starts on December 27th and continues into January and February. That's based upon the Chinese individuals actually purchasing gold. They're actually very large consumers of gold, and coming into the Chinese New Year, and you tend to find that helps drive the price of gold up at that time of the year. So this is over the last 10 years. You can see here, and I've used the dates from October 10th to December 27th, that gold on average tends to go down in this time period. And so this has happened 8 out of 10 times where you've seen gold go down between October 10th and December the 26th as well. And that's represented by, so the blue arrows represent approximately December the 10th, and the red arrows represent the start of that period from December the 10th as well, when the gold has actually gone down. You can see here negative 2.8, down 7, down 8, down 4, down 7, down 10, down 1. In this case, it was up 6. So this is one of the 2 times we did see that. Not a big, huge uptick, by the way. But that was, if you take a look, we have to remember what happened in that particular year. We saw gold actually going down. The stock market bottomed on December 24th at that time. And we did see the stock market, gold actually pull up from that level once the Powell was able to convince the investors that yes, they had made a mistake in the Federal Reserve and they're doing a pivot, and don't worry, they'll be there to support them. But let's take a look at 2019. We saw the strong move upwards. And look what happened in 2019. Despite the strong move upwards, we did see this. We saw this pullback that started in mid-September, and that's a little bit of what's happening right now. So a little bit of a repeat from what happens, and we can see gold, although gold finishes the seasonal period in early October. Now, gold tends to be weak in the whole month of October, but on average, some strong moves with momentum can actually push gold higher at the beginning of October. But momentum can fade, and you sort of have to be on your toes a little bit. Momentum can fade for a gold in mid-September. And that's what we saw last year. And we saw gold continue to slide down until towards the end of the year, and then it took off from here. And we've seen the same thing take place right here in 2020, where gold actually in mid-September started to pull back as well. We don't know for sure from October 10th to December 26th if we're going to see that same phenomena where gold tends to be weak, which often leads into a good season, into a good next seasonal period from late December into January and February as well. So we don't know yet, but I wanted to talk about gold because it's been such a media focus, but because it does have a little bit of a weaker seasonal period at this time of the year, especially if we do see interest rates tick up. So if we see, and the US dollar is really driving a lot of the marketplace, so we start to see interest rates tick up here, and also dollar strength, which it could be iffy given the election as well with what's going on. But if we do see that take place, we'd expect gold in this period to actually pull back a little bit, although it could be a long-term good hold as well. But now I want to finish off the presentation talking about the election years. Now, I know I talked a little bit about this year, in my last month's presentation, but it's important enough for actually to go back over this, because here we are, we're just getting really close to the election, less than a month away at this point. So the black line represents the overall average for the S&P 500 from 1950 to 2016. The red line represents the election years, year 4, which we're in right now, in the same time period as well. And the gold line represents the election, the year for the S&P 500 in 2016. The overall trend is for the stock market to actually, in September and October, to actually pull back here in the election years. Now, you can go back and take a look at the Dow from early 1900s. It's got the same general trend overall, and that's because investors get a little bit anxious. They're uncertain about what the outcome's going to be, and they're concerned. They say, well, I'll just hold back on my risk a little bit. We did see that pullback in September. We really haven't seen anything in October yet. But it's interesting to note that the bottom of the market tends to actually happen before the election. Now, I know maybe the election gets contested and everything else. We don't know those facts. I'm just taking a look at what's happened in the past. A lot of uncertainty, a lot of pessimism, and then the stock market tends to do well. And also, too, in 2016, we saw exactly the same phenomena. So most of the time this happens, not all of the time. These are average lines, and there are times where the stock market can be higher, but on average it tends to be that the stock market does tend to pull back at this time. And the flip side, the stock market on average in election years tends to perform well from late October into the end of the year. So most of the time this takes place. Over 70% of the time in election years you tend to see the stock market higher as well. And it doesn't matter on average if it's Republicans or Democrats that win. It's just a removal of uncertainty that takes place, and the stock market tends to move higher. And right now you're seeing all sorts of articles coming out in the media going, oh, if Trump gets in, it'll be good for the stock market. And then other articles saying, oh, if Biden gets in, it'll be good for the stock market, because he's going to spend, the Democrats will spend a lot of money and there won't be tax increases down the road. All these things are hard to predict, but some of the uncertainty would be removed. And on average, the overall trend has been for a higher stock market from late October into December. So here we are in 2020, in the month of October. We're in what tends to be one of the more volatile months of the year, and it is the election year, so we have to be a little bit cautious, and there are opportunities. Now, I do want to just summarize a little bit and say that, if you take a look overall, generally speaking, the volatility that happens in October tends to provide good opportunities. Now, I know we've seen the stock market moving up over the last few months in a time where it tends not to do so well, and that's for a number of reasons. The Federal Reserve pumping money, the government's giving a lot of money away, and all that sort of stuff. But on average, overall, we do see the stock market tending to move higher. So weakening in this time period in October, volatile, and which actually provides good opportunities that sets up for the next positive 6 months on a seasonal basis for the stock market. Thank you very much for joining me today.